GameStop is a failing US video games retailer. In January 21, its stock was heavily shorted by hedge funds who saw declining sales and expected the share price to continue dropping. By the 22nd, the stock was so heavily exposed that it reached 140% short interest to total shares traded. Retail investors on Reddit's Wall Street Bets noticed this extreme position and began coordinating mass purchasing in response. By doing so, the share saw price movement from around $4.50 on the 10th to a closing price of $347 on the 27th, forcing hedge funds who had theoretically unlimited exposure to exit their positions at a significant loss to preserve liquidity. The event shows several behavioural biases taken to extremes. The first of these is herding behaviour. Individual traders copied the investment decisions of major voices on platforms like Reddit and Twitter, buying the stock solely because others were as well without their own due diligence. As more participants entered the market solely to buy, the price skyrocketed with no regard to fundamentals. Decisions were determined by trending posts and driven by a heady cocktail of memes and anti-establishment sentiment, driving the magnitude of the stock's meteoric rise. There is clear evidence showing the relationship between social media and purchasing volumes. In this chart we see the members count for Wall Street Bets. This forum was the centre of news and coordination by retail investors, therefore we can use this as an indicator for retail interest in GameStop. There is a very noticeable spike in members in January 21, strongly indicative of herding. This table shows the highest and lowest trading figures of GameStop before and after the 13th of January 2021, when the short squeeze took place. The middle segment shows the sheer scale of the surge. Before then, the highest volume ever traded was 77 million shares in October 2020, with the highest after being almost 200 million on the 22nd of January 21. These two factors are strongly correlated. Confirmation bias describes how individuals prefer information that confirms their existing beliefs or hypotheses and dismiss contradictory evidence. Retail traders listen to community narratives that emphasize being part of a revolution against Wall Street, opposing traditional analysts and institutions. This reinforced emotional investment in the belief that GameStop stocks would keep rising. Posts on Reddit supporting holding or buying GameStop were upvoted en masse. Opposing posts were dismissed. Many held their long positions even after GameStop began to decline in February in hopes of future gains. The narrative against Wall Street also drove many to hold out of spite. Sentiment analysis by academics shows that positive sentiment towards GameStop grew even despite falling stock prices. The same study also found that an increase in anti-establishment Reddit posts about the stock preceded spikes in trading volume, more evidence tying community sentiment to market action, showing confirmation bias in motion. Our third bias, overconfidence, is shown clearly throughout the period. The behaviour of hedge funds prior to the GameStop saga shows that overconfidence in their knowledge pushed them to short sell excessively. They then held their positions longer than sensible against adverse price movements. Melvin Capital lost 49% of its value in early 21 and needed a $3 billion bailout to survive. We also see overconfidence on the retail side. After the price bubble in January, it peaked at a massive $483 per share on the 28th. Following this, there was a $100 drop in price a week later. Many retail investors were left holding the bag, some having invested far more than sensible due to excitement and suffering losses to their overconfidence. To prevent such a market event from reoccurring, we identified two main regulatory measures. The first would be regulators using sentiment-sensitive circuit breakers that halt trading activities in response to abnormal price action. This measure even occurred in this case, but not as a good faith measure to protect market integrity. On January 28th, trading platforms like Robinhood restricted the purchase of heavily shorted stocks like GameStop, allowing only sell orders. While Robinhood cited rising collateral demands from the DTCC as the cause, many claimed it a violation of investor rights designed to protect hedge funds from the consequences of their own actions. Nevertheless, this measure did halt the momentum of the squeeze. It does work. The second is for online platforms to include compulsory education before allowing new traders access to risky instruments like options and crypto, ensuring new investors understand the behaviour of different types of assets and their movements. This could help prevent retail investors from over-leveraging volatile positions and bankrupting themselves on false premises like many did in 2021. Both interventions target overconfidence and herding by raising informational awareness and minimizing the influence of disinformation seen on social media. Together they could increase market efficiency, blunting emotionally driven trading activity without limiting access to retail participation. In summary, the GameStop incident shows how cognitive biases are amplified through social media to distort market efficiency. The sudden rise in GameStop's price was solely due to the irrational behaviour of market players and had nothing to do with the reality of the business underlying. The addition of targeted interventions like sentiment circuit breakers and risk education both helped stem the market consequences of irrationality and would serve to prevent another chaotic saga like GameStop, for better or worse.